Hey guys, you've heard the tip. Just buy near future infrastructure and you'll make a fortune. New train line, new motorway, new hospital, easy money, right? But what if buying in the wrong pocket of that project means lower prices, higher vacancies, and years of construction pain, while other investors quietly profit just a few streets away? In this video, I'm going to show you the exact mistakes to avoid when investing near future infrastructure and how to do it properly so you're on the right side of the tracks, literally and financially. And stay with me because later in the video, I'll break down a real world style case. Two investors, they buy in the same suburb near a new railway station, one right on the busy corridor, the other in a walkable sweet spot pocket, and over 10 years, the difference in capital growth and rental demand is massive. So let's start with a reality check. Infrastructure absolutely matters for property values. Research across Australian cities has shown that suburbs within walking distance of a new rail, metro station can see price growth premiums, sometimes 7, 10, even 15% higher than surrounding areas, once the project is complete. One study out of Sydney found homes within 800 metres of new metro stations saw up to 15% premium in price growth compared to the broader market. Another study on Melbourne's Murray Rail extension found an 8.7% uplift near new stations. So yes, done well, future infrastructure can be a powerful tailwind. But here's a problem. Most investors hear the announcement, they see the glossy marketing images, buy anything near the project without looking at the map, the staging, the impact zones, or actual timing. That's how you end up buying on the wrong side of the freeway, or in a construction war zone for 8 years, or in a pocket that actually loses through traffic and footfall once a bypass opens. So today, this is not a chase the infrastructure hype video. This is a don't get burned guide. So let's look at mistake one. Confusing the announcement with delivery. Governments love announcing infrastructure, business cases, corridor protections, preferred route maps, election promises, but there's a huge difference between a project in an early planning idea phase versus a project with funding committed in the state or federal budget and a project with contracts signed and construction underway. Take some of the big road projects historically. Commentators point out that for projects like the M7 and others that could be almost 10 years from early talks actually opening. In that time, investors who bought purely on future infrastructure, they can spend years with no change. Or worse, years of disruptions or partially work starting and then not starting, stalling. Meanwhile, they've paid a premium because they bought ahead of the market based on speculation. So infrastructure in Australia and state planning bodies consistently stress that value impacts are very hard to isolate and often depend on completion, not just announcements. So here's a rule. Speculative phase equals high risk, biggest potential disappointment. Funded and contracted equals safer, still a little bit upside. Under construction and nearing completion, you can often see the pattern of winners and losers starting to emerge. So before you buy, what you want to know is this fully funded? What is the expected start and finish date? Is it already under construction or is this still just a press release? Mistake number two, being too close. Transport infrastructure's impact tends to follow what some analysts call a proximity principle. Close enough to benefit from connectivity, far enough away to avoid the noise, pollution, vibration, and heavy traffic. Raywhite research on transport projects has shown that properties within comfortable walking distance of a new station or freeway access often get strong premiums, but those immediately adjacent to noisy corridors can actually see values drag down. So what they pointed out is properties right up against freeways and major roads can actually devalue due to the noise and congestion. The winners are typically the streets that have easy access to the major road, not the ones that front directly onto it. And construction phase impacts can be brutal. There's excessive noise, dust, truck movements, temporary road closures, and diversions. Analysis of construction noise cases in New South Wales showed that rental properties near prolonged construction suffered rental income losses around 10 to 15%, with high tenant turnover and even some tenants temporarily moving out. EPA Victoria and other regulators have whole frameworks just around managing construction noise from major infrastructure because of its impact on the residents. So if your entire strategy is, I'll just buy the closest dwelling to the station entrance or the ramp, you may be walking into a lower buyer appeal, noise and vibration complaints, or even longer vacancies because tenants choose quieter streets just a bit further back. Think rings, not dots. The dot is a station or the interchange. The sweet spot is the ring that's usually 400 to 800 meter zone. Easy walk, but not facing the busiest frontage. So before you buy, literally walk the streets. Stand on the main road at the peak. Listen to the noise. Check how many trucks, buses, trains you can see or hear. Now ask yourself this, would you live there? Or would you choose the quieter pocket nearby? Mistake number 3, underestimating how long and how disruptive construction will be. Most marketing around big projects shows that shiny finished stations, landscape bike paths, and happy commuters. The reality, especially for multi-year rail tunnels, road interchanges, or mixed-use precincts, they look like pile driving at 7 a.m., weekend and night works, dust, fencing, detours, heavy vehicles in and out all day. Legal analysis of New South Wales have called construction noises a hidden cost of buying near off-the-plan and infrastructure sites, and cited data like 20% of off-the-plan developments experiencing delays that extended construction. Legal analysis out of New South Wales have called construction noise a hidden cost of buying near off-the-plan and infrastructure sites, and cited data like 20% off-the-plan developments experiencing delays that extended construction noise well beyond original timelines. Tenants near heavy construction experiencing 10 to 50% rental income loss and to 25% turnover as they bail out. So environmental agencies like EPA Victoria document for things like the suburban rail loop that dedicate entire sections to noise, vibration, and electromagnetic interference because it can be that disruptive. That disruption can suppress rents during construction, make tenants more sensitive and likely to move, depress resale values in the immediate term. Now, is that always bad? Not necessarily. If you buy at the right price, in the right pocket, and with the long-term lens, construction pain can be the price you pay for future uplift. But the mistake is buying at a premium based purely on the finished product, then being shocked or disappointed when your short-term yield and rentability get smashed during years of construction. As an investor, you want to plan for a period of potentially weaker performance. Have an extra buffer in your cash flow. Strong property management team that can communicate with tenants and manage expectations correctly. Mistake 4 is about going all in on a single project. Investors, they fall in love with the map, a new motorway, a light rail line, a hospital expansion. They say this would change everything for the suburb. But serious research into value capture around Australian infrastructure consistently find that the impact of a single project is hard to isolate. The uplift that it varies hugely by exact location and pre-existing demand. Some areas barely move, others jump, some even lose demand if flows are rerouted. Smart analysts, they stress that infrastructure should be one of the several drivers, not the whole thesis. You still need to tick the fundamentals: diverse employment base, population growth, low tightening vacancy, limited new competing supply, livability, walkability, schools, shops, services. Infrastructure Australia's own work on value capture talks about needing the right combination of land use, planning, zoning, density, and complementary investments to actually realize value gains. A line on a map isn't enough. So the right question isn't, where's the next train line going to be? It should be, which suburbs have solid fundamentals already in place, where future infrastructure is an extra tailwind, not the whole story. All right, so we know big road projects are especially tricky. We've seen plenty of cases where new bypasses take heavy traffic away from a town, killing passing trade, local business demand, or a new arterial road creates congestion at certain intersections, making some pockets less attractive, not more. Now, a great example would be around Sydney and the Macarthur region, where a new road like Cow Pasture Road was supposed to fix congestion, but actually it shifted it, creating new bottlenecks and delays until later stages could be funded and built. If you bought purely on better access is coming, you might sit there for years in what feels like a traffic swamp or a car park, not a premium connected location. And in some regional areas, towns that got bypassed saw reduced through traffic, decline of retail and footfall, softening of certain commercial residential values because the town became less of a stopover. So with roads, you need to ask, is this project bringing people through this area or taking them around it? Will this ramp or exit make the suburb more convenient or simply help people get past it faster? Where will the noise and congestion points actually end up once traffic patterns change? So let's cash in that foreshadowed example. Two investors, let's call them Emma and Luke. Same project, a new suburban rail station in a growing corridor outside Brisbane. Same timing, both by 5 years before the station opens, when construction is just starting and the area is getting hyped. So the market, median house price today is $600,000. Expected long-term growth with the new line, moderate to strong, say 4 to 5% a year once complete, based on similar projects. Now Emma buys right opposite the future station. Main road frontage, directly facing the construction site, no off-street parking. Purchase price of $620K. She pays a slight premium because it's closest to the station. During construction, constant noise, dust, weekend works, tenants complain about trucks and early morning pile driving. Her rents end up 10% lower than she'd hoped, and she has more frequent vacancies. Very similar patterns seen in New South Wales, where construction noise cut rental income by 10 to 15% and spiked turnover. Once the station opens, she gets some uplift, but the property still has busy road noise, commuter parking battles, less appeal to families who prefer quieter streets. Over 10 years, her property grows at an average 4% per annum, reaching around 888. Now, Luke, he buys 600 meters away in a quiet pocket, still an easy 7 to 8 minute walk to the station. Side street, low traffic, better aspect. Similar house type, but slightly better block. He buys at 580, a bit cheaper because it's not on the doorstep of the new station. During construction, tenants notice some noise, but it's distant. Access is mostly fine. He maintains close to market level rents with relatively normal turnover. Once the station opens, history becomes highly sought after because it's walkable but quiet. Families and professionals pay premium to be within walking distance without the main road downside. So over 10 years, with the combined effect of the broader growth and strong demand for a street type, his property grows 5% to around 944. So they both invested near future infrastructure. Emma paid a premium upfront, copped construction pain, ended up with noisier, less flexible asset. Luke, he paid less upfront, got manageable construction impact, and ended up in a true sweet spot pocket. So same project, same suburb, very different outcomes on micro location and planning. So how do you do it right? Let's finish with a simple checklist. You can use this before you buy near future infrastructure. 1. Confirm the project status. Is it just an idea, a business case? Is it funded in the state or federal budget? Are contracts awarded and has construction commenced? You want to see funding and clear timelines, not just press releases. 2. Map the winners and losers. Pull up detailed project maps and impact assessments. Where are the stations, ramps, noise walls, tunneling sites? Where are predicted noise and vibration impacts during construction and operation? Aim for walkable distance to the benefits. Enough separation from heavy noise, pollution, and visual blight. 3. Stress test the construction phase. Ask, how long will the major works take? What kind of works? Is it tunneling, elevator structures, road widenings? What's actually happening and how close are they? Plan for short-term rent softening, higher tenant churn, and extra buffer in your cash flow while the project is being built. 4. Check the fundamentals independent of the actual project. Would you still invest in the suburb if the project was cancelled tomorrow? Look at current vacancy rates, existing demand drivers, so jobs, schools, amenities, supply pipeline. Are there thousands of new apartments coming online? Infrastructure should be the cherry on top, not the whole cake. And 5, think long-term exit and liquidity. Smart advisors point out that liquidity matters. If your circumstances change, can you sell quickly to a broader buyer pool? Assets that front freeways, sit under flight paths, or face permanent heavy vehicle routes often have a narrower pool of buyers and are more price sensitive. You want the properties that appeal to owner-occupiers, benefit from connectivity, are not permanently compromised by noise or design. Now, if this has helped you see both the upside and the traps of buying your future infrastructure, tap the like button on this video. It actually tells us that people want to see newest content, not just buy the next station, you'll get rich type stuff. And let me know in the comments, are you currently looking at a suburb with a big project on the way? What is that project? Rail, road, hospital, and what's your biggest concern about buying there? Your answers help shape which suburbs and projects we deep dive into next. Now, if you're thinking, I can see the opportunity around these projects, but I don't want to accidentally buy on the wrong side of the road or the noisy pocket that never really pays off. This is exactly where a proper strategy session pays for itself many times over. In that session with our team, we'll look over the specific infrastructure projects that you're watching, overlay them with real data on vacancy, demand, and supply in those suburbs. We can map out the micro locations, streets, pockets where you're more likely to capture uplift without copying the worst of the downside, and plug that into a broader property strategy so you're not just chasing one project, but you're building a portfolio. So if you want that level of clarity before you commit to hundreds of thousands of dollars on the next best thing, hit the link below, book a session with us today. We'll help you work out whether that infrastructure hotspot is a genuine opportunity or is it just all hype. Thanks, guys.